Hello everybody, let's do a quick mid-year FY18 review. On a 5-year basis, KLI's frontline and opportunities themes have returned about 16 and 17% respectively against a Nifty return of about 11%. Both these equity themes are also in the first quartile during this period. Balanced funds with 60% equity has returned about 14% during the same period. KLI's dynamic bond fund also has returned about 9.5% during this 5-year period. Now let's do a quick look at the macros. FY18 GDP is now expected in the range of 6.5 to 7, lower than what was expected earlier. Second half FY18 inflation is expected to be in the range of 4.2 to 4.6%. Foreign exchange reserves over 400 billion US are at a comfortable level. Current account deficit is expected to be below 2% with a balance of payment surplus. Indian rupee is expected to be in the range of 64 to 67. On the global front, interest rate hikes and balance sheet reduction in the US needs to be watched, as also the end of quantitative easing in Euro region. Domestically, formalization of the economy and financialization of savings is expected to continue.
Let us do quick recap of events in last 6 months. Equity markets are up 6.6% during this period, supported by strong domestic flows. Mutual funds have received inflows of $16 billion since April 2017, of which $12 billion has been invested in secondary markets. We expect these flows to sustain on the back of favorable policy conditions for financial inclusion. FIs have been net seller to the extent of $1.1 billion in line with their action in other emerging markets. Earnings growth has been sluggish due to short-term disruption caused by demonetization and GST implementation. Consensus earnings on Nifty are expected to grow around 10% for FY18, but it is expected to pick up to around 20% for FY19. Low earnings from December 16 onwards quarter will set a favorable base for earnings growth going forward. Longer term, the government's commitment towards economic reforms will help achieve faster economic growth through improvement in productivity. We expect economic growth to be supported by exports and consumption in the short term. Accordingly, KLI portfolios are overweight on domestic consumption theme like retail banks, automobile and consumer durables. Valuations are reasonable, with Nifty trading at price to book of 3.4 in line with this long-term average. Stabilization of GST regime and festive demand will be key events to monitor for next few months. Risk to market comes from reversal of flows due to monetary tightening by US Fed, economic slowdown in China and large equity issuance in India. Favorable macro and reasonable valuations offer attractive opportunity to invest in equities with 3 to 5 year perspective.
Half-year FY18 has been a year of reform and its aftermath. Two crucial reforms, DMON and GST, has been implemented. On one hand, DMON has improved the banking system liquidity as cash has been converted into deposits. On other hand, GST is going through near-term implementation challenges. However, both these reforms will start showing positive outcomes in medium term via formalization of the economy and higher tax to GDP ratio. On inflation front, the low capacity utilization and low food prices ensured 6 months average inflation at 2.5%. The inflation is expected to inch up to average 4% in remaining part of the year. Lower inflation helped RBI reduce rates by 25 basis points to 6%. At 6% policy rates, the real yield post-inflation is 2.5%. GDP growth has faltered at 5.7% in Q1 owing to weak investment demand and probable destocking before GST implementation. Investment to GDP ratio has also fallen to 27% from 32%. On interest rate front, we believe much of the easing in the current cycle is behind us. Still, we see RBI reducing rates by another 25 basis points if inflation prints remain below 4% for next couple of quarters. Lower growth has raised the risk of fiscal slippage. Government may opt to borrow more to kickstart the economy. Higher borrowing will probably lead to higher yields in the bond market. Amid inflation-focused RBI and weak fiscal position, we see 10-year bond in the range of 655 to 675 till the clarity on fiscal position emerges. Higher borrowing will probably breach the upper band of the range. As highlighted at the start of the year, FY18 appears to be a year of accrual income than much of capital gains. However, we still believe that higher yield rates will ensure the reversal of the rate cycle to be less steep.
In conclusion, bonds are expected to provide accrual-based returns with some volatility. The ratio of earning yield to 10-year GSEC continues to favor allocation to equity with a medium to long-term horizon. Goals which are long-term in nature should have an allocation to equity for inflation-adjusted returns. Best of luck and happy Diwali to all.